Hi, this is Phil Greenwood, and this is our third session for the Wisconsin Entrepreneurial Bootcamp in the Financial Statement Background Series. What we want to do with this section is just give you a series, an example series of transactions made by a company and how this gets recorded to their financial statements. The company is Next Wave Incorporated, and they make video cabinets for the casino market. When they start business, they sell some stock via an IPO, initial public offering, 5 million shares at $1 a piece. And you can see that we'll record the cash received from that stock sale as assets. And we have to record an offsetting entry for the cash and record it to equity for the stock sold. In other words, our shareholders gave the company $5 million for purposes of running the business. Additionally, the company needed more money to build a new plant, and so they're going to take out a $10 million bank loan. Well, initially we'll get the loan from the bank. We'll put another $10 million in cash, not spend it yet on the plant facility, and then we're going to have to record a liability for the loan in which we'll owe the bank $10 million over a certain amount of time. Now notice this did not go to equity, and why that is because the bank does not get an ownership interest in the company like shareholders do. So they get treated like any vendor would be as far as showing the obligation of money we owe to them. If we were to summarize a balance sheet and income statement at the end of both of these transactions, the company's got $15 million in cash. We owe $10 million for the bank and $5 million to the shareholders. The total assets equals total liabilities plus equity. No revenues or expenditures yet for the income statement. As part of that $10 million loan, we begin and build the plant and distribution center. In other words, we spent $7 million. We take that $7 million that we got from the loan out of cash, and we create an account called fixed assets for property, plant, and equipment that assigns a value to the asset for the plant and distribution center. Finally, we're going to start building our product for sale to our casino clients. So we need computer components. We're going to get $2 million that we're going to purchase from a new Asian supplier through our supply chain. Well, in this case, we're going to go ahead and buy the inventory with cash, or $2 million, and we're going to create an asset account called raw materials, which is part of inventory, which is going to tell us how much product we're bringing in that will sit on the shelf that will eventually go into manufacturing to create our new product. At this point in time, you can see the company started with $15 million in cash. Now we've spent $7 million on the fixed assets. We spent $2 million on the raw materials, so the cash has gone from 15 down to 6. The liability side shows what we still owe the bank and how much the shareholders have in the company. Again, the liability and equities equal the assets. No income has been recorded yet for the production and sale of the product. As part of our production, we got to hire some employees to assemble our state-of-the-art video cabinet, the product called the Yellowbird. So in this case, we spent $3 million in labor that will be directly attributable to building of the product. We also took some of that $2 million that was sitting on the shelf in raw materials. We transferred it from raw materials into finished goods as part of the finished units that we will sell to our customers ultimately. How does this get recorded to the income statement and the balance sheet? Well, in this case, we pulled $3 million out of cash for the labor. We took $1 million of the inventory, which we'd already had spent. We take it out of raw materials. We combine that with the labor and create finished goods inventory. So in inventory, we now have $4 million worth of units that will eventually, hopefully, be sold to outside customers. In order to sell this product, we had to take out some advertising ads and also some trade shows. So what we're going to do is we hired an ad agency to help us with this. The events are scheduled for November, but we're not actually going to pay the bill to the ad agency until 2005, the next year. So how would you record this various activity? Well, first off, because we're going to get billed but not pay it, we have to record an accrual and liability to show that we owe the $1 million to the ad agency, which will show as an accrued expense. And because we incurred an expense, trade show and advertising, in November of 2004, that's going to be related to the sale and movement of the product, we can now show the company has some operating expenditures. In that particular time frame, there were no other expenditures, so bottom line, we lost $1 million. When we close out the income statement at the end of the month or end of the quarter, that $1 million loss gets kept in the business. So in other words, we have to account for the loss on the balance sheet, which goes into the equity section. And when we run a summarized income statement and balance sheet, you can now see that cash is down to $3 million. Our inventory is at $5 million, which included the raw material transferred to finished goods plus the labor. Our fixed assets are still there at $7 million for the plant and distribution center. We show liabilities of $11 million, and down below you can see the equity now. The stock of $5 million is reduced by the amount of the loss retained in the business. All these transactions add up to make sure they balance between the assets equal to liabilities and equity. On our income statement, we finally have some activity, only $1 million, but we're showing a loss, an operating loss of $1 million going forward. Finally, we have some product sales in this example. The company sold in December of 2004 5,000 Yellowbirds. They sold it for $1,000 per unit, which will be $5 million. We sold it on terms to Harrah's, the casino, in that if they pay within 10 days, 2%/10, what that states is if they pay within 10 days, we'll give them a 2% discount off their invoice. The inventory, which was $4 million, costed out, divided by the number of units in inventory, the inventory only cost $400 per unit that we're selling for $1,000 per unit. So how do we account for that? Well, first off, we show the sales net of the discount, $4.9 million. We have cost of goods sold. This is the expense of the inventory, the $400 times the 5,000 units that we made, which incorporates both the raw materials and the labor that went into building the product. So the 5,000 Yellowbirds times the number of units. So our cost of goods, which will come out of inventory, the expense is cost of goods sold, $2 million, will give us gross profit of $2.9 million, which flows down to bottom line income of $2.9 million. Because the customer is not paying us until probably the next year, we set up an account receivable showing that they owe us the $4.9 million. We reduce the inventory for the amount of the cost of goods sold by the $2 million. And the profits from the sale, and that's in operating income, will then flow through to the equity section as part of the profits retained in the business. Now we do a new summary of the income statement and balance sheet. You can see combining all the transactions, the income statement on the right shows income of $1.9 million from the sale of the birds, less the advertising expenditures. Cash flow, you can see now we're down to $3 million in cash because we had to pay for the plant, labor, and a variety of other things. But we do expect accounts receivable of $4.9 million, which will be paid hopefully in 2005 from the customer. Our inventory is down a little bit. And you can see on the right side the liabilities don't change too much except for the earnings. Both the balance sheet's still in balance at $17.9 million. As part of paying our executives and our various other folks in the corporate office, we had to spend $1 million in administrative expenditures. A lot of this went for our sales force because they made that great sale to Harrah's. We record that by pulling the money out of cash. We classify that as what we call SG&A, or selling, general, and administrative expenditures, which flows down to an operating loss of $1 million. That, again, will go back to the balance sheet as a retained loss in the business. When we summarize, before we summarize and do a final balance sheet and income statement, we have to do a couple other things before we close out the books. One is we have to take that plant and distribution center, which we paid $7 million for, and we actually will depreciate it. In other words, we plan for that center to last for 10 years, so we expect the value to decline by $700,000 per year in the form of what we'll call depreciation expense, or in this case, manufacturing expense. That $700,000 will flow through as an operating loss, go into equity as a retained loss. We'll now create an account on the asset side called accumulated depreciation, which will offset the original cost of the fixed assets, leaving the net fixed asset value at $6.3 million. We now run a final income statement and balance sheet. You can see they are in balance. We did run a little bit of a profit, an operating income of $200,000, but a couple things to kind of point out here is look at what happened to our cash flow. Our cash that started off at 15 million is down to 2 million, but yet we only had income of 200,000. So a number of things happened during that time frame that reduced our cash flow by 13 million bucks. That hopefully we'll get future benefit for in the next situation. One of the things we'll really watch is this company's cash is down quite a bit, and if for some reason that customer doesn't make a timely payment on the accounts receivable, they could find themselves in some kind of cash flow problem. So just an example of how transactions get recorded to a balance sheet and an income statement, and the process that takes place in summarizing it and closing out the books at the end of the quarter or end of the year.